Imagine you're buying like a wildly successful, incredibly popular local restaurant.
Okay, I'm with you.
Right, so you look at their bank account, and it is just absolutely overflowing with cash. The bottom line looks fantastic.
Sounds like a great investment so far.
Right, but what the current owner completely fails to mention to you is that they funded that bank account by quietly selling off the restaurant's roof.
Oh, wow. Yeah, that's a massive problem.
It is. And today, we are looking at how a multi-million-dollar reality was completely hidden in plain sight, just by changing the title of a single column on a spreadsheet.
I mean, it's the ultimate illusion in financial reporting, really.
Yeah.
Getting the math perfectly right, but communicating a total falsehood. And honestly, it happens way more often than most investors realize.
So true. Well, welcome to a brand new deep dive on the GAAP Advisors Ind AS Clinic podcast. We are so thrilled to have you with us today.
Happy to be here.
Our mission today is to really unpack the incredibly complex and sometimes murky world of financial statement presentation. We're going to deconstruct the hidden dangers of formatting errors and how, burying one specific number can just entirely alter the financial profile of a massive company.
But before we start pulling those threads, we do need to establish our foundation with a pretty important disclaimer.
Oh, absolutely. Go for it.
So the views expressed in this deep dive are the personal views of the author of our source material, and they are not binding on you, the audience.
Right, standard procedure.
Exactly. We strongly request that you seek the help of a qualified expert before taking any action or, refraining from any action based on the views we're discussing today.
Yeah, that is absolutely crucial to keep in mind. Always consult your own experts.
Yes.
So let's talk about the origin of today's source material because it's fascinating.
It really is.
We're looking at a specific real-world observation, and this was featured in the 234th edition of the GAAP Advisors Task Weekly newsletter.
Authored by C.A. Manish C. Iyer, right?
Yes, exactly. Authored by C.A. Manish C. Iyer, who is the director at GAAP Advisors. And this is published on LinkedIn, by the way.
Which is an incredible resource.
Totally. They've published over 230 editions to date. So if you're on LinkedIn and you care about financial transparency, which if you're listening, you probably do, you really need to subscribe to that newsletter for free.
Yeah, you really do. And, what makes this particular observation so fascinating is that it's not some, hypothetical whiteboard exercise.
Yeah, not a textbook problem.
No, not at all. This comes directly from the published Ind AS financial statements of an actual listed company.
A real company with real money on the line.
Exactly. These financials were downloaded and independently reviewed by GAAP advisors on a suo motu basis, meaning they just took the initiative to review the public records themselves.
I love that.
Yeah, and they found this glaring anomaly just hiding in the architecture of the numbers.
So we are talking about real investors, real equity, real stakes. And just to make sure we're operating with the exact same parameters as this company, let's just quickly lay out the rules of their specific game.
Good idea.
So for the financials we're analyzing today, the functional currency and the presentation currency is the Indian rupee, or INR.
Right. And any currency that is not the functional currency is officially considered a foreign currency under these rules.
Perfect. Furthermore, and this is pretty standard in the Indian corporate landscape, the reporting period we're looking at begins on the 1st of April and ends on the 31st of March.
Okay, so now that those boundaries are set, I think we need to do a little bit of conceptual groundwork before we just throw a bunch of numbers at you.
Yes, please. Context is everything here.
The anomaly we are investigating today takes place in a very specific part of the financial statements. It's the statement of changes in equity.
Which we'll just refer to as the SOCIE going forward, right?
Yeah, the SOCIE.
Yeah.
And specifically, we're looking at its relationship with OCI, which stands for Other Comprehensive Income.
Okay, I want to pause you right there because we throw around acronyms like OCI and Ind AS very quickly in this industry.
It's true. It becomes second nature.
But for someone who might be like an operations expert or maybe a newer investor listening right now, we really need to demystify these terms.
Absolutely.
Because Indian accounting standards, or Ind AS, they fundamentally changed the landscape when they converged with the global IFRS standards. They shifted the focus really heavily towards substance over form.
Yeah, which was a massive philosophical shift for a lot of preparers.
Exactly. But OCI, other comprehensive income, it still trips people up. So conceptually, what actually is it? Like, why doesn't everything just go straight into the normal profit and loss statement?
That is the perfect place to start. So think of the regular profit and loss statement as the scoreboard for the company's actual realized day-to-day operations.
Okay, so like the core business stuff.
Right. You sold a product, you paid your employees, you paid the rent, and you made a profit. That money is realized.
It actually happened.
Yes. But companies also have unrealized gains and losses, things that have shifted in value on paper, but they haven't actually been cashed out yet.
Oh, okay.
So OCI acts as this highly regulated holding pen, or like a parking lot, for these specific unrealized items.
So it keeps them separate from the daily operational stuff.
Exactly. It prevents these massive temporary paper swings, like, say, the value of a long-term investment fluctuating wildly, from totally distorting the company's actual operating profit for that year.
Okay, that makes total sense. So OCI is the parking lot for unrealized volatility. I get that. And what about the SOCIE, the statement of changes in equity?
Right. How does that fit in?
Yeah, because I used to think of it kind of like a mailroom where everything just gets sorted into slots, but that feels a bit too static for what it actually does.
A better way to visualize the SOCIE is to think of it as a financial DNA tracker.
Ooh, a DNA tracker. I like that.
Yeah, because the balance sheet, it just tells you what the company's equity looks like on March 31st, a snapshot, but it doesn't tell you how it got there. The SOCIE tracks every single mutation in the company's wealth over the entire course of the year.
So it's tracking the movement.
Exactly. Did the wealth grow because of operational profits? Or did it grow because the owners injected new capital?
Right.
Or did it mutate because of those unrealized shifts just sitting out in that OCI parking lot?
That is such a helpful way to look at it.
The SOCIE breaks down the exact DNA of the company's net worth across these different, highly specific columns.
A financial DNA tracker.
That's great. Okay, so let's look at the specific DNA sequence of this listed company from April 1st, 2018 to March 31st, 2020.
Let's do it.
I am going to walk you through the columns under their reserves and surplus heading. And I'll round the numbers slightly here, just so we can see the big picture without drowning in all the digits.
Walk us through the landscape. Like, what does a primary user actually see when they open this specific statement?
First, we have the capital reserve column, and it's holding incredibly steady at roughly 59.8 million rupees across the entire 2-year period. It does not budge. Okay. And next to it.
Right next to it is the securities premium reserve. Also totally flat, sitting pretty at roughly 106.3 million rupees.
Very standard behavior for those specific structural reserves. No red flags there.
Right. Then we move to the retained earnings column. Now, this is the operational engine room, right?
Exactly. This is the realized profit flowing in.
So we start with roughly 14.8 million rupees on April 1st, 2018. Then they add in their realized profit for the year, and they end that first period at roughly 35.6 million.
Solid growth.
Yeah. And the next year, they add another 13.9 million in profit, ending on March 31st, 2020, with a retained earnings balance of roughly 49.5 million rupees.
So far, this DNA tracker is showing a perfectly healthy, growing organism. The operational profits are flowing cleanly straight into retained earnings.
Is the absolute picture of corporate health. But then we arrive at the very next column.
Here we go.
This column has a highly explicit, very specific title. It is labeled Equity Instruments through Other Comprehensive Income.
Okay, so pause right there. Based on our parking lot analogy, following that logic, this column tracks the unrealized paper gains or losses specifically tied to the stock or market instruments the company has invested in, right?
Exactly. That is exactly what the label on the jar clearly advertises.
Right.
But for the period ending March 31st, 2019, this column shows a massive hit, a negative figure of roughly 741.8 million rupees.
Ouch. That's a big hit.
And then for the next period, ending March 31st, 2020, there's another massive negative figure, precisely negative 381,232,568 rupees.
Wow. Okay, so if you are a primary user, say you're an institutional investor trying to assess the company's treasury management, you look at that column heading, equity instruments, and you see negative 381 million rupees for 2020.
Yeah.
What is the immediate logical conclusion you were forced to draw from that?
I mean, you would immediately assume their investment portfolio just took an absolute beating in the market. You would assume the fair market value of whatever external shares they are holding just plummeted by 381 million rupees. You were judging their investment acumen entirely based on that one number.
And if you did that, you would be making a significant analytical error, entirely because of how this company chose to present its data.
Really?
Yes. This brings us to the moment where the illusion breaks. Because to understand what is actually inside that column, you cannot just look at the SOCIE.
You have to dig deeper.
You have to trace the DNA back to the other comprehensive income section of the statement of profit and loss.
Okay, let's trace it then, because I actually have the OCI section of the P&L right here in front of me.
Perfect. What does it say?
We are looking at the specific category, items that will not be reclassified to profit or loss. And this is where the true components of that negative 381 million figure are finally exposed.
Break those components down for us, because this is where the exact math becomes really vital.
Okay, the first component is labeled fair valuation of financial instruments through OCI, and the amount here is a loss, specifically a negative 381,432,771 rupees.
Okay, wait. So that is the actual unvarnished truth about their equity investments.
Exactly.
The market value didn't drop by 381.2 million like the equity column said. It dropped by over 381.4 million rupees.
Yes, but the total in the equity column was only negative 381.2 million. So where is that difference coming from?
Where indeed?
It comes from the second component sitting in the OCI section. It's labeled remeasurement gains or losses on defined benefit plans.
Ah.
And this number is positive. It is a gain of 264,427 rupees. And right underneath that, there is the tax effect on that specific gain, which is a negative 64,224 rupees.
Leaving them with a net positive gain of roughly 200,000 rupees strictly related to their employee-defined benefit plans.
You've got it. So we take the massive market loss on the equity investments, that negative 381.4 million. We add the small actuarial net gain on the employee plans, the positive 200K, and boom.
It nets out.
It perfectly nets out. We arrive at the exact final number shown in the SOCIE column. Negative 381,232,568 rupees. The company combined them into a single line item.
They netted them against each other and just hid the smaller one.
Yes. But I'm going to push back on your behalf here because I know exactly what a lot of preparers and honestly even some auditors would say in defense of this practice.
Let's hear it.
If I'm the CFO of this company, I'm looking at you and saying, wait, what is the actual harm here? The bottom line net asset value of my company hasn't changed by a single rupee.
Right. The math is technically correct.
The overall retained equity is 100% mathematically accurate. If I have $100 in losses in my left pocket and $1 in gains in my right pocket, my net position is a $99 loss. Why would regulators care if I put it all in column A or column B? The investor still sees the final mathematically pristine number.
I hear that all the time. It is the most seductive argument in accounting, and it is fundamentally wrong. Because the assumption there is that the only purpose of financial statements is to provide a final mathematical sum. But under Ind AS, presentation is communication.
Okay, elaborate on that.
The architecture of the numbers is just as important as the numbers themselves.
Because the architecture tells you where the risk is located in the business.
Precisely. To understand why regulators care so deeply about this, we have to look at the statutory blueprint that governs the physical layout of these statements.
You're talking about Schedule 3, right?
Yes. We are talking about Division 2 of Schedule 3 to the Companies Act 2013.
Okay, so Schedule 3 is essentially the architectural blueprint. It dictates exactly how the house needs to be built so that an investor or an auditor knows exactly where the load-bearing walls are and, where the plumbing is located.
That's a great analogy. Schedule 3 was developed to create rigorous comparability across the entire Indian corporate sector.
Because before that, it was kind of the Wild West.
Completely. Before these stringent formats, companies had wide latitude to present numbers basically however they felt painted the best picture. Schedule 3 removed that subjectivity entirely.
Right.
And it contains a highly specific rule regarding the statement of changes in equity, particularly how a company must handle the remeasurement of defined benefit plans.
Okay, let me pull the exact text from the Schedule 3 note, just so we have the precise legal language.
Yes, read the rule.
It states, remeasurement of defined benefit plans and fair value changes relating to own credit risk of financial liabilities designated at fair value through profit or loss shall be recognized as a part of retained earnings with separate disclosure of such items along with the relevant amounts in the notes, or shall be shown as a separate column under reserves and surplus.
Okay, I know that is incredibly dense statutory language, but it actually creates a very strict either-or mandate.
Yeah, there's no gray area there.
Exactly. The law provides exactly 2 legal avenues for presenting these employee benefit remeasurements.
Okay, so option A is that it must be recognized as a part of retained earnings with a clear disclosure in the notes.
Right.
So you could just put the employee benefit gain in the retained earnings column, which we already established earlier was purely showing operational profit.
That is the first legal path. You put it in retained earnings and disclose it in the notes. And what's option B?
Option B is that it shall be shown as a separate column under reserves and surplus.
Yep.
So you literally build a brand new DNA strand in the tracker, explicitly labeled for employee benefit remeasurements.
Those are the only two choices. Now, evaluate what the company actually did against that strict statutory blueprint?
Well, they ignored option A entirely. The retained earnings column only contained the profit for the year.
Right.
And they certainly ignored option B. There's absolutely no separate column for defined benefit plans anywhere on the page.
So what did they do instead?
Instead, they took the net gain from the employee benefit plans, quietly subtracted it from the massive loss on the equity instruments, and presented the netted out figure entirely inside the equity instruments column.
They hid the plumbing inside the electrical box.
They totally did.
Hmm.
Which really forces us to ask the deeper philosophical question here. Why is Schedule 3 so pedantic about this?
That's a fair question.
Like, why did the lawmakers specifically single out defined benefit plan remeasurements and force them into retained earnings or their own isolated column, entirely cordoned off from things like equity instrument fluctuations?
That is where things get genuinely interesting.
Because to a layperson, or even a junior accountant, both of these items share a fundamental characteristic, right? They both bypass the regular profit and loss statement and go straight to other comprehensive income.
Right. They are both unrealized.
Exactly. So why the strict legally mandated segregation?
It comes down to understanding the profound economic difference between those two items. They are fundamentally distinct species of financial data.
Okay, break that down for us.
Let's examine the first one, the fair value change of equity instruments. This is an external, market-driven financial asset.
Right.
When a company invests in the stock of another entity, the value of that stock fluctuates based on global sentiment, macroeconomic conditions, or, a sudden change in interest rates.
It is entirely outside the operational control of the company itself.
Completely outside.
Like, if they hold shares in a microchip manufacturer and a global supply chain crisis hits, the value of those shares tanks.
Yeah.
That loss has absolutely zero reflection on how well our company is running its own core daily operations.
Exactly. It purely represents market risk and investment volatility. Now, let's contrast that entirely with the remeasurement of defined benefit plans.
Okay.
What actually is a defined benefit plan in practice?
It's a promise.
Yes.
It is the company saying to its employees, hey, you work for us for 20 years. We guarantee you a specific pension payout or a gratuity upon retirement.
Yes, exactly. It is a massive long-term operational liability that is deeply tied to the company's human capital. But the company doesn't actually know exactly how much that promise will cost decades from now. So what do? They hire actuaries.
And this is where the remeasurement part comes in, right?
Yeah.
The actuaries are basically building a predictive model of the future.
They are. Actuaries have to estimate the present value of a future obligation, and to do that, they have to rely on complex assumptions.
Like, what kind of assumptions?
Well, they estimate salary escalation rates, like how fast will wages grow over the next 20 years. They estimate mortality rates. How long will the retirees actually live to collect the pension?
Wow, okay.
And critically, they use a discount rate based on current market yields to determine what that future pile of cash is worth in today's money.
So if the broader economy shifts and the yield on government bonds drops, the discount rate the actuaries use also drops.
Yes.
Which means the present value of that future liability suddenly skyrockets.
Correct. The company suddenly owes mathematically more money to its future retirees, entirely due to an assumption change. That actuarial shift is the remeasurement loss, or conversely, if things move the other way, a remeasurement gain.
Okay, I am really seeing the chasm between these two items now. The defined benefit plan is fundamentally an internal operational reality. It is deeply tied to human resources, compensation strategy, and these long-term demographic estimates.
While the equity instrument is an external, unpredictable market gamble,
Right.
Schedule 3 forces companies to segregate the defined benefit remeasurements into retained earnings, or a separate column, because those actuarial shifts are considered a core, inescapable part of the company's operational equity over time.
Because you can't run a business without employees.
Exactly. You cannot run a business without employees, and you cannot escape the demographic realities of those employees.
But you can absolutely choose whether or not to gamble your extra cash in the stock market.
Precisely. By shoving the complex actuarial HR liability math into a column explicitly labeled for equity investments, the company completely blurred the lines between internal operational obligations and external market volatility.
Which means any analyst who is relying on that column is looking at thoroughly contaminated data.
Highly contaminated.
So, if the statutory blueprint of Schedule 3 explicitly forbids this, how did the company actually execute this maneuver mechanically? Like, what accounting standard did they have to break to force these two numbers together in the spreadsheet?
Well, they had to commit what is often considered a cardinal sin in financial reporting.
Oh, dramatic. I like it.
They violated Ind AS 1, which is the core standard for presentation of financial statements. Specifically, they violated paragraph 32.
Let me read paragraph 32 because the language here is incredibly uncompromising.
Really is.
It says, an entity shall not offset assets and liabilities or income and expenses unless required or permitted by an Ind AS.
It is a negative command, shall not offset.
So no netting allowed.
Right. The default foundational position in Indian accounting standards is that you must show gross numbers. Transparency requires the user to see all the moving parts.
You can't just hide the mess.
Exactly. You cannot net things out just to make the presentation look cleaner or to simplify a table unless a specific individual standard explicitly instructs you to do so.
So let's look at the mechanics of the offset in our specific case study here. The company took the fair value changes of equity investments, that brutal 381.4 million rupee loss.
Yep.
And they netted it against the remeasurement of defined benefit plans, the roughly 200,000 rupee net actuarial gain.
Right.
And they squished them together into a single combined negative 381.2 million rupee line item, right on the face of the SOCIE.
They essentially used an operational HR gain to mathematically soften the blow of a market investment loss.
Going back to my analogy at the very beginning about buying the restaurant, it is exactly like the restaurant owner handing you a single sheet of paper that just says net bank balance change, plus 10,000 rupees.
And you think the business is booming.
Right. But what they offset to get that number is that they actually made 50,000 rupees selling amazing steaks, but they suffered a catastrophic 40,000 rupee expense when the roof collapsed.
And by offsetting a core operational revenue selling the steaks with a massive unusual capital expense, the roof repair, the owner destroys your ability to accurately value the business.
Completely destroys it.
You have absolutely no idea what the actual profit margin on the food is, and you are totally blind to the fact that the building's infrastructure is failing.
The company, in our case study, did the exact same thing. They took the stakes, the market performance of their equity portfolio, and offset it with the roof repair, the actuarial changes in their employee pension obligations.
Exactly.
So the ultimate legal test here is, does any Indian accounting standard permit or require offsetting a fair value equity loss against a defined benefit actuarial gain?
Absolutely not. No Ind AS permits this. It is an undeniable direct violation of paragraph 32.
Which naturally leads us to question the impact. If a company breaks this rule, what is the actual consequence for the person reading the report? Because Ind AS doesn't just treat this as a victimless administrative typo, do they?
Not at all. Ind AS treats this as a severe failure of communication. And this is where we need to introduce paragraph 7 of Ind AS 1.
Okay, what does paragraph 7 do?
It officially defines the concept of obscuring information.
Let's read the definition. Paragraph 7 states, information is obscured if it is communicated in a way that would have a similar effect for primary users of financial statements to omitting or misstating that information.
I really want you to consider the weight of that sentence.
It's heavy.
It is. The standard setters are literally equating the act of obscuring information with the act of omitting or misstating it.
That is massive. They are basically saying that if you hide a material fact in the confusing way, it is legally and ethically equivalent to just deleting the fact entirely or flat out lying about it. Obscuring equals omitting.
It raises the stakes of presentation exponentially. And paragraph 7 actually provides 5 specific examples of circumstances that result in material information being officially obscured.
Okay, so it gives a playbook.
Yes. These aren't just guidelines. They are a literal playbook of bad behavior that auditors are specifically trained to look out for.
So if obscuring is the same as lying, how do companies actually do it? Let's walk through these 5 methods of hiding the truth, because I think this is fascinating.
Sure. Let's start with the first one.
The first one is vague language. The standard says information is obscured when it is disclosed, but the language used is vague or unclear.
Right. A classic example of this is a company burying a massive threatening lawsuit settlement under a line item vaguely titled, like, miscellaneous operational adjustments.
Just totally generic.
Exactly.
Yeah.
The number is mathematically on the page, so they didn't omit it, but the vague language ensures no user will ever understand the legal risk the company just faced.
Wow, okay. Method number 2, scattered information. The standard warns against information regarding a material item being scattered throughout the financial statements.
This is the classic needle in a haystack technique, which has been famously utilized in some massive historic corporate frauds.
Oh, I bet.
You put a tiny fragment of a complex derivative transaction in Note 3. You bury the collateral risk way over in Note 17, and then you put the maturity dates in Note 42.
So you technically disclosed everything.
Technically, yes. Every piece of required information is printed somewhere in the annual report. But a user would literally need a corkboard, red string, and 3 weeks of free time to piece the puzzle together. You obscure the total risk by destroying the cohesion of the data.
That is so sneaky.
Huh.
Okay, method 3 is where I think our company falls. Inappropriately aggregating dissimilar items.
Yes. This is like taking apples, oranges, and a pair of shoes, throwing them all in a box, and labeling the box household items.
Technically true, but totally useless.
Exactly. You destroy the specific utility of the data by merging fundamentally different things together.
Then we have method 4, inappropriately disaggregating similar items, which is the exact opposite strategy.
Yes, this is weaponizing excessive detail.
How does that work?
Imagine a company has 15 different regional bank accounts that all basically serve the exact same operational cash purpose. Instead of rolling them up into a clean, single cash-in-cash equivalence line item, they list every single account individually on the face of the balance sheet.
Just cluttering the page.
Exactly. They create so much visual noise and clutter that the user gets overwhelmed and cannot see the broader financial trends.
Death by 1,000 data points.
Exactly.
And the final method, number 5, material information is hidden by immaterial information.
This is essentially burying the headline.
Right.
The company dedicates 5 dense, incredibly detailed pages in the notes to explaining the accounting policy for some trivial 10,000 rupee petty cash fund. But they only dedicate 1 cryptic sentence to a 500 million rupee contingent liability.
They drown the user's attention in trivialities so the actual danger goes unnoticed.
Precisely.
So we have vague language, scattered fragments, inappropriate aggregation, excessive disaggregation, and drowning the material in the immaterial. Looking at the company we are dissecting today, they are unequivocally guilty of method 3, right?
Absolutely. They aggregated dissimilar items.
They took an actuarial assumption about a 30-year-old employee's future pension and merged it with yesterday's closing price of a tech stock.
And by doing so, they officially presented obscured information.
I am trying to visualize the real-world fallout of this specific obscuration. Put yourself in the shoes of a primary user, maybe a credit rating analyst, assessing the company's risk profile.
Okay, let's play that out.
They open the SOCIE, they look at the other equity section, and they see this obscured data. How does their analysis actually break down?
Their analysis is compromised on 2 entirely separate fronts. Let's look at the equity investment side first.
Okay.
The analyst looks at the column heading, sees a loss of 381.2 million rupees, and models that specific number into their assessment of the treasury portfolio.
But they are modeling a falsehood.
Yes. Because the actual market loss was worse. It was 381.4 million. The company successfully used an internal HR gain to artificially inflate the apparent performance of their market investments.
They basically made their treasury department look slightly less reckless than they actually were.
Exactly. Now flip to the second front, the employee benefit side.
Right, the actuarial gain.
Because that roughly 200,000 rupee actuarial gain was entirely swallowed whole by the massive market loss, it completely vanished from the face of the SOCIE.
It's just gone.
If the analyst is trying to track the volatility of the company's long-term HR liabilities, they see absolutely zero evidence that the defined benefit plan was even remeasured that year.
The liability shifted, but the DNA tracker showed no mutation. The user is entirely blind to it.
And that means the financial statement has failed its core objective. It is no longer providing transparent, understandable, and relevant information. It is just providing a mathematically balanced illusion.
This highlights exactly why a suo motu review by GAAP advisors is so incredibly valuable. It strips away the illusion.
It really does.
But we don't just want to be forensic investigators pointing out the flaws. We want to provide actionable value for you today. so you don't make this same mistake in your own reporting or auditing.
Yes, let's talk solutions.
How should this company have formatted this data to stay on the right side of Ind AS 1 and Schedule 3?
Well, the solution is rooted in accurate labeling and clear cross-referencing. The fundamental sin was that they used a highly specific, restrictive column heading equity instruments and then just stuffed unrelated items into it.
They mislabeled the jar.
Exactly.
So what is the right label?
One perfectly compliant approach would be to utilize a broader, more accurate heading. Instead of forcing specificity right on the face of the statement, they could have titled the column simply Other Comprehensive Income.
Oh, okay. So a wider jar that accurately describes the nature of all the unrealized items inside it.
Yes. However, and this is the critical step, you cannot just drop a netted number into that broad jar and walk away.
Because that would still be offsetting.
Exactly. If you use the broad Other Comprehensive Income heading on the face of the SOCIE, you must disaggregate the distinct components in the notes to the financial statements.
So the face statement provides the aggregate summary, but the notes serve as the magnifying glass.
Correct. And to fully satisfy the transparency requirements of Ind AS 1 and Schedule 3, the SOCIE must contain an explicit, unambiguous cross-reference to those specific notes. The architecture has to actively guide the user.
So the user sees Other Comprehensive Income, negative $381.2 million, see Note 45.
Yes.
They follow that breadcrumb, turn to Note 45, and the illusion is instantly dispelled. Note 45 clearly splits the numbers. The $381.4 million equity loss is shown completely distinct from the $200K employee benefit net gain. Transparency is fully restored, and the standard is met.
Precisely. Because the company failed to provide that broad heading with a clear cross-reference to disaggregate data, they violated the negative command against offsetting.
Tracing this whole sequence, from the statutory demands of Schedule 3 to the philosophical differences of actuaries versus markets, all the way down to the definition of obscuring in Ind AS 1, it is staggering how much complexity is packed into a single column heading.
It really is.
I can easily envision a stressed finance team burning the midnight oil to meet an annual report filing deadline, simply mapping a general ledger account to the wrong automated column in their software.
Happens all the time.
And boom, they have inadvertently obscured material facts.
The complexity of Ind AS application is immense, and the intersection where Ind AS 1 presentation rules collide with Schedule 3 statutory formats is exactly where a massive number of companies stumble.
Which is exactly why I want to make sure you know about a vital resource that can navigate this exact type of complexity. If you're dealing with granular, high-stakes presentation questions, you need to utilize the GAAP Advisors Issue Repository.
It is an unparalleled resource in this field. I cannot stress that enough.
It truly is. If you visit gapadvisors.com, they host an active issue repository containing over 4,500 specific issues and detailed responses covering both Ind AS and Indian GAAP.
4,500. That is a massive archive.
It is. That's over 4,500 real-world, highly complex accounting dilemmas that have been systematically solved, documented, and archived.
And honestly, the most remarkable aspect is the barrier to entry, or rather, the lack of one.
Exactly. Any person can register on the site for completely free. Once registered, you have the ability to submit your own specific issues regarding Ind AS or Indian GAAP.
Which is huge.
If you are staring at a complex offsetting dilemma, or you are unsure how to map a new derivative instrument into Schedule 3, you just submit the issue. You will then receive a highly detailed, technically backed response delivered straight to the inbox of the email you registered with.
I really want to emphasize how critical this specific service is, particularly for statutory auditors right now.
Well, absolutely.
The regulatory environment right now is intense. Regulatory bodies, especially the National Financial Reporting Authority, NFRA, are reviewing audit files with incredible scrutiny.
It is no longer enough to just land on the right number. You have to comprehensively document the journey of exactly how you got there.
Exactly. An auditor desperately needs to document exactly how they addressed complex Ind AS application issues, like the presentation anomaly we dissected today.
They need a paper trail.
Right. If an auditor spots a potential offsetting violation, they cannot just have a quick verbal chat with the CFO and sign off. They need a documented technical position.
And the repository gives them that.
Yes. By submitting the issue to the GAAP Advisors repository and receiving a formal, reasoned response, the auditor secures a vital piece of independent audit evidence. It demonstrates that they sought expert consultation and arrived at a well-founded, standard-compliant conclusion.
It essentially helps bulletproof the audit file. But for the finance teams who are actually preparing these statements in the first place, why wait for the auditor to find the mistake? This brings us to the ultimate value of preventative care.
Proactive compliance is universally cheaper, less stressful, and way less damaging to market reputation than retroactive correction.
Absolutely. We heavily promote the idea of getting your financial statements reviewed by GAAP advisors before you sign them.
Before the ink dries.
Exactly. Do not wait until the board meeting. Do not wait until the document is published and someone like CA Manishi Iyer discovers a structural flaw during a suo moto review. You can get a pre-signing review done.
And the process is designed to be highly efficient for the preparer.
Very simple. You take your financial statements, get them into a near-to-publishing PDF format, meaning fully formatted, notes included, structurally ready to go, and you email that PDF directly to info@gapadvisors.com.
It's that easy.
Yep. The experts at GAAP Advisors will review your architecture with the exact same rigorous forensic attention to detail that we just applied to this single column heading today.
They'll find the leaks before you launch the ship.
Exactly. They ensure that you are fully compliant with Ind AS and Schedule 3rd before the ink ever hits the signature page.
It provides profound peace of mind. It ensures your presentation isn't inadvertently obscuring material facts or, violating a rigid negative command, because as we have proven today, the math balancing at the bottom of the page is absolutely no defense against a failure of presentation.
It really isn't. The math is just step one. As we bring this deep dive to a close, I want to leave you with a final lingering thought to ponder the next time you open a set of financial statements.
Yeah, let's wrap this up. We spent this time looking at the architecture of a highly regulated listed company.
Right.
A company equipped with sophisticated internal controls, experienced finance directors, and statutory auditors. Yet, despite all those layers of professional review, they inadvertently obscured critical, fundamentally dissimilar financial data.
It's wild to think about.
And they achieved this massive distortion simply by mistitling a single column and offsetting two numbers.
It literally took a few keystrokes to hide millions of rupees of operational reality.
So the vital question you must ask yourself is this: how robust is your own review process?
That's the real question.
When you are staring at a statement of changes in equity or any aggregated line item in an annual report, do you just check that the math ties out to the profit and loss statement and move on? Or do you critically question the label on the jar?
Right.
What dissimilar items might be hiding in plain sight, entirely obscured within the aggregated columns of the financial statements you rely on every single day?
Are you looking at stake profits, or are you looking at a leaky roof? It is a provocative question, and one that every financial professional, investor, and student needs to be asking themselves.
Constantly.
I want to sincerely thank you for dedicating your time to this deep dive today. We know your time is immensely valuable, and we hope this granular exploration of Ind AS 1, Schedule 3, and the true cost of obscured data has armed you with a much sharper, more forensic perspective on financial presentation.
The devil is always in the details, and mastering these nuances is what separates basic reporting from exceptional, transparent communication.
Well said. If you found the insights in today's deep dive valuable, we have a small request. Please share this show among your contacts, your colleagues, your audit teams, and your finance departments.
Pass it along.
And crucially, please share it with students pursuing the CA course. They are the future architects of our financial systems, and helping spread this vital, practical knowledge of Indian accounting standards is incredibly important for the integrity of the profession.
It really is.
Finally, please make sure to follow or subscribe to the GAAP Advisors IndAS Clinic podcasts. You can find us on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to the GAAP Advisors IndAS Clinic podcasts on.
Don't miss an episode.
Hit that subscribe button so you never miss a deep dive when we unpack the next complex issue in financial reporting. Until next time, keep questioning the numbers, never trust a column heading just because it looks neat, and remember that in accounting, true precision isn't just about balancing the books. It is about telling the clear, unobscured truth. Take care.